Our speaker today is Mr. Tim Clark. Mr. Clark works for Cypress Real Estate Advisors. He's president of that company. They're an Austin-based company. They develop and invest in a variety of property types, primarily in the South. He operates in the private equity fund world, and it's kind of interesting. I talked about Mr. Clark and his firm a number of times in class this morning because in that class we happen to be talking about, well, real estate private equity. So hopefully I didn't say anything you'll completely contradict this afternoon. He has an undergraduate degree in accounting from the University of Florida, and he has an MBA from the Wharton School of Business. Responsible for all their acquisition and disposition activity, as well as coordinating their development. Some funds don't do any development. They at times do quite a lot. So I'm excited to hear his presentation, and we welcome you back to Florida.
Okay, thank you. Wow, quite the crowd, and I'm obviously excited to be here. I'm definitely a proud Gator, and I know some of you are all undergrads and grad students, and so you have different levels of thing, but I'm definitely a proud Gator and excited to be here. Before I start, I want to make three comments. One, I'm hoping that I have a semi-organized presentation, but you will find that I am a stream of consciousness speaker. I can move from one topic to the other faster than you can keep up. So you got to kind of bear with me there. I kind of jump from topic to topic, but I'm going to try and match up with my slides a little bit. Second, I always, and this will pop up again in my presentation, I always say that, kind of when you're getting into the real estate business, you're going to learn a lot of facts, okay? Remember, I'm not an academic, so I'm not teaching you facts, okay? So you want to learn a lot of facts, but you want to collect a lot of opinions. And I always tell people that come in and interview with me that the reason you want to talk to multiple people in the office is they all have different opinions. And you got to figure out which ones are right and what market's hot and what market's not hot and what property, and so I'm going to give you some facts, I'm going to give you a lot of opinions, and I'll leave it up to you to discern which are which. So that's my second thing. And the third thing is, when I went back through my presentation, I thought, some of these statements I'm making are really obvious. You kind of say, I'm going to invest in a market that's got good demographics, rental rates are going up, all those obvious things. And so those sound really easy. What's tough about it that I found in the business is consistently maintaining the discipline to do the obvious. Okay, so it's easy to say one thing, but when you look at a long career and you're looking at real estate, you got to keep the discipline to follow the obvious. And I'm going to give you an example of that always, or in the presentation. So I want to kind of throw in those caveats. So when I say something, you go, well, geez, Tim, you're not telling me anything new. That's obvious. Remember, there's a whole level of discipline that goes with that when you're in the real estate investment business. Let me make sure I can get started here. Well, before I start, as Dr. Ling said, it's Tim Clark. I'm with Cypress Real Estate Advisors. We're out of Austin. I graduated with an accounting degree from Florida in 1980. So my route to real estate is a little different, kind of an entrepreneurial start. I mean, really, I went into public accounting, went to grad school, went back in consulting, and then one bright morning woke up with the idea, based on a discussion with my brother the prior weekend, that he and I and an assistant were going to go into the real estate business. Now, he actually had some real estate background, so it wasn't quite as bad as it sounds. But we basically started as a three-man shop in 1990 kind of. And, we'll kind of talk about where we've gotten and what we've done. One thing I would tell you, that first 2 years, I think back and go, wow, I didn't sleep much that first 2 years. It was a really interesting time, and it was a nerve-wracking time, but when you kind of look back on it, you kind of go, it sure was fun. And so while I didn't get out of school thinking I was going to be a real estate major or real estate career, I did have a good financial background, and that'll be part of my discussion today, that we think that's really important in real estate, and it's a great background to have. So kind of a circuitous route. But I have been in the business for 25 years. Like I said, my brother and I founded and owned Cypress Real Estate Advisors, and we've grown since then. But anyway, The presentation, I'm going to talk about Cypress Real Estate Advisors. I was telling Dr. Ling, really what I'm telling you about is my career and what I've done when I look at this presentation. And so I'm going to tell you a little bit about Cypress Real Estate Advisors. I'm going to talk a little bit about private real estate funds, how they're structured, how we got, how you get into that business. A little bit about Cypress's investment strategy and approach. And I'm not sure that it's real different than anybody else, but there's certain things that every real estate company kind of focuses on. A little bit about our fund history and just a couple investments. And when I get to the investments, the key is not this investment had 30 acres and it was an apartment complex. I've tried to focus on just a few key points that makes that. We've done 103 investments, you'll see, and I've got 4, maybe 5, I can't remember. And I'm going to try and point out what I thought was interesting about them. And one of them is no more than it was my favorite project, and I want to tell you about it. So, so we'll focus on a little different spin on the investments. A little bit on current market and activity. This, to me, is the toughest thing. I'm in Austin. Florida's different than Texas. Real estate's a real local business. There's a lot of opinion in that part of the discussion. And then finally, kind of finish up, and I know a lot of you are partially through the recruiting process, but just a little bit on recruiting, how we as an organization are functionally set up. Not that we as an organization really, that's that important, but it shows you the different functions so that when you are interviewing, you are talking to people, what there is out there. And then a little bit of, I guess I finished with sort of my success factors. So that's kind of where we're at in terms of presentation. Like I said, Cypress is based in Austin. It was my brother and I founded it 25 years ago. We actually started in Houston. At the time, our big investor said, go to a big city with a big airport, and when your sole investor tells you to go somewhere, you do it. We later moved to Austin after we had sort of established ourselves. Like I said, we have 25 people and have grown sort of over the years. We probably will not get bigger than 25 people. That sort of works for us in our niche, which I'll talk about later. We are basically a private real estate fund. Now, we started out as a developer. We wanted to develop product and rehab product that raised our capital in a fund format. Okay, so instead of going and finding a deal and finding capital for that deal, we went out and raised a fund and then funded our deals. So it was a little different structure. As the market got a lot stronger, kind of at 2000, early 2000s, and the fund size got bigger, for a while, we could do enough deals to take care of the fund. As the funds got bigger, we got into a situation where we started investing with other folks, where we were a limited partner or a passive investor in different JV type deals. And so kind of our middle set of funds, we were more an investment shop. I would say now we're kind of we do a little bit of investment and actually a lot of development, but it's all been market driven. And so, as the market's moved, we've tried to move with it. When you talk about private equity funds, you usually have a core fund, a core plus fund, kind of raising return and risk level here, a value add fund, an opportunistic fund. Our investors look for us to do the value add and the opportunistic. We are not a core fund that goes out, buys at a stabilized apartment complex and tries to create, a 6 or 8% return. So we're on the riskier side, and that's what our investors look for. Our investors are basically tax-exempt institutions, endowments and foundations. Basically, I'll give you a couple examples. I don't have any University of Florida's endowment money, but I do have like Vanderbilt's an investor, or University of Michigan, or Northwestern. So we have schools like that, basically they're endowment funds, and then we have foundations. And a couple examples would be like the Mayo Foundation. So they haven't, put this money aside to basically support their mission and their healthcare, and they basically parcel out their money to private equity funds like us we're kind of on their private or alternate type investments. And so all of ours, we do not, and it wasn't that we made a conscious decision, we just never went this path. We really don't have much pension money, we don't have much private money. We have kind of stuck with that, those type of institutions. Our fund size, our first one was 80 million. We were ecstatic. I mean, that was like, we were so happy with that. We peaked at about 450. Our largest one was $458 million. And our last two funds have been in the sort of 100 to 150 range. And I'll kind of circle back to why we've kind of targeted that for ourselves. The rest is just a lot of numbers, just to give you a feel. I don't really focus that much on numbers, but over the course of the company, we've put out $1.4 billion in the funds. And I guess the one thing I would say, if you look at the 2.9 in gross assets, that shows you that we're at a little less than 50% leveraged. An apartment deal, we'll leverage 70%. A land deal, during the good times you can get some leverage on it, the bad times you can't. So we tend to be a little lower leverage. So when our investors look at us and say, your return's X, then they compare it to how leveraged we are to kind of determine where they feel we are on the risk spectrum. And kind of currently, really at any time over the last few years, we usually have about $1.2 billion in assets under management. There we go. So really private real estate funds, and this may be before some of y'all's time, if you think back to the late 80s or 90s, if you can think back that far, big real estate crash, a lot of the real estate was driven by, a lot of the real estate was financed through leverage. In fact, they'd go out, they'd buy a project for $50 million, and they go out and borrow $55 million. So they were borrowing literally 100 and something percent. Market crashes, this was especially, think about it, we were in Texas, Houston was the worst. You'd had the oil crash in the 80s, and buildings were empty. And so basically, at that point, what you saw is private funds start to really exist for the first time. And it was a way that a lot of the prices were way down, the debt was going away because the Resolution Trust Corporation, basically the government had put that in place to take all the bad assets from the banks and the savings and loans, et cetera. So there was a need for capital. And so these private equity funds, it's kind of the first time they started to really grow. And if you think about it, what's happened was a lot of the debt was replaced with equity. And the whole idea was to, bring those investors to allow them to invest directly in real estate. So they didn't have to buy through buying stock in an investment company. A lot of these types of investors, they're not big enough to do their own, they don't have the staff to do their own direct investment. So it allowed them to go through an entity, a private real estate fund, and get into real estate directly. The key, we feel like, is you sort of aggregate similar type investors who have similar type goals together, and it's a channel for them to get into sort of a alternative investment. The legal structure is usually a limited partnership. It can vary. We have an LLC, we have a REIT because of some tax issues, and the whole key to these private equity deals is really from the institution's point, is to try and align their interest with our interest, okay? And how can they govern us, and we'll talk about it a little bit in the document, but, and so a lot of the structure is driven by governance, liability issues, tax issues, and just the alignment of the manager and the investors, okay? And so you had sort of the private funds come into being. This is sort of, I'm trying to compare private real estate funds to deal fund, to deal by deal capital. And there's advantages to each structure. We chose to go the private real estate fund direction. And what's great about it, if you think about the process, it's a one-time raise of capital. We go out, we raise $100 million. Okay, so it's a one-time process. Our investors do fund level due diligence. Okay, they're not looking at each deal. The capital, once it comes to us, in our case, now this isn't true of all private equity funds, so I need to be a little careful here. Our capital is discretionary. They make a commitment to us, and once they've made that commitment, we decide what deals we do in our office. Now, I have to admit, I talked to some folks earlier, and we were talking discretionary versus not. Our first fund was not discretionary, okay? The institutions wanted to approve deal by deal. But once we got past that, our funds are discretionary. And so what that allows you to do, and I'm going to circle back to this thought on one of the deals, is it allows you the ability to quickly close on a transaction. Time is money. There's folks out there looking for capital for deals that they got to close by a certain date. Their financing only lasts a certain date. they get a little nervous and they come to you, and you're usually in a better, stronger negotiating spot. So we have several deals that we've done over the years that nothing but the ability to move quickly, and that's the key to the fund thing. A little side point is, in a fund structure, you do have ongoing asset management fees, which probably doesn't mean much to y'all, but the key there is when you do it deal by deal, you only have fees when you're doing deals. When you have a fund, you have an asset management fee that keeps your lights on and keeps the door open, okay? So it's a subtle point, but it's an important point when you're out there in business. The negative is your financial terms are not as favorable, and we're gonna walk through those, and the returns are all commingled. Huge points. And think about the fact that financial returns are not as favorable. The reason they're not as favorable is they're not getting to look at every deal. And so, and you haven't, they haven't been able to do their diligence and everything. So literally, it's kind of one of those situations where they're not getting a say, you've got committed capital, so you can't negotiate as strong a deal with your institutions as you can on a deal-by-deal basis, where you've put pursuit dollars in, you've done all your due diligence, and they know exactly what they're investing in. The second point is commingled returns, and this is the key point. When I do a fund that has 10 deals, if I have basically all the returns of those deals go up through a fund. So if I have 9 winners and 1 loser, the loser drains the winners, right? When you do deal by deal, contrasting, you're raising fund per deal. So if you have 9 winners, you put that capital in your pocket. You take that loser and you say, oops, we lost, okay? And so there's advantages to the fund capital in that, if the fund format, in that you have readily available capital and you've got committed dollars and you can do deals. You do pay for it in the commingling of your funds and the returns, okay? So kind of flipping the other side, I'm not going to go through all those, but I do think, you know, if you think about just, I'm going to go down to the negative side to deal by deal. So you're raising capital deal by deal. You know, there's due diligence on every deal that you've got to provide to every investor. There's much more scrutiny. They're much more involved in your decision-making process. It takes longer. You can't do deals as fast. You can spend a lot of time and money on a deal that you never get financed. So it's kind of a trade-off. We made the decision to go the fund format. I can tell you there's a lot of developers that go, why would you ever do that? On a deal by deal, you get a 40% back in. On a fund deal, you get a 20% back in. Go ahead. Well, I think, to be honest, you think about it, we're a niche fund. You know, we're 150 million or 400. I mean, Dr. Lee and I were talking about Blackstone raised $14.5 billion in 26 days. And so, you know, the funds tend to have more capital, and so I think the size of the firm tends to get bigger, and it has fees to support that firm. Where on a deal-by-deal thing, you're keeping your overhead low. It's very, you know, you're not able to ride the ups and downs quite as much. So maybe indirectly, I guess I would say that. I mean, there are, you know, and then you got to, when you think of some big real estate companies, a lot of those might be private or they're REITs, or so they're a completely different structure. So, did I answer that? Okay. Fundraising process. Basically, we go out to our investors to raise capital. And, you know, if you think about it, you have a whole set of legal documents, legal review. It's a big startup process. You have to do a roadshow. We go out to our investors, or new investors, annual investors. We meet with them, you know, present our strategy, our history, all those things you'd think we'd present. So you have to do a roadshow. After that, they want to come visit you. They want to see that you have an office. It is amazing. They literally want to come and see, make sure you have an office. And so, you know, they come visit. It's a long time frame. Usually, raising capital is at least a year. And then you do a first close. There's multiple closes, so 18 months. I would tell you for a normal capital raise, it's at least 18 months. So it's a long process. And it's very, you know, person-hour intensive and a lot of effort. But obviously there's a lot of reward if you get it closed. Fundraising documents, you normally have a private placement memorandum, which is a document like this that basically says, I'm raising this money, the lawyers write it, and it talks about your history and your strategy and the risk and taxation, and basically covers all the legal side. that you present, and that's actually a very formal legal document that is highly proofed and accurate. Your pitch book is normally kind of a shorter, nice presentation, talks about, you know, the deals you've done and has a lot of pretty pictures and is more your kind of in-person thing. And then you have all your fund documents. You have your limited partnership agreement, which is truly the partnership agreement that binds everybody, subscription documents. It's a very intensive legal process. We actually use a law firm out of Boston. Even though we're out of Austin, we use a law firm out of Boston because it's kind of a very specialized kind of set of legal documents and knowing all the issues and liabilities. So it is a very involved, time-consuming process. On the manager selection, people say, well, how did you get this? You know, they do a lot, these institutions do a lot of diligence, and a lot of it, initially it's very difficult. In fact, right now, a new fund, it's very difficult because managers, the institutions are actually kind of cranking down the number of managers versus going up. If you hit it at the right time, you know, timing's everything. But, you know, they're going to want to talk to you about your fund strategy, what you invest in, where you invest in, what do you think you're going to do with the money. And some funds say, I'm going to do industrial, or some funds say, I'm going to do office. We're a little looser than that, but we'll talk about that. I mean, we actually started out as a very general fund, but over the years have tried to narrow the focus down because they like that. They're obviously going to look at your prior experience, you know, all your investments. You know, the kind of operational skills. There's a level of, you know, do you develop? Have you developed? Are you know, have you done rehab? Have you operated it? So just sort of your real estate operational skills, where you're going to invest, what product. I talked about that a little bit. And then the last point is kind of interesting. Back office operations sounds sort of mundane. These institutions really, really focus on your back office. Do you have the accounting so that you can provide reports? Do you know, have your human resources, your payrolls? They really do focus on that, and that's actually the hardest thing for new funds, is they don't have a back office. But institutions want you to provide all that information for them. They don't want to have to figure it out themselves. So, you know, that's actually a key issue. So, kind of in the process, they do a lot of diligence, but in our case, it's not deal diligence, it's entity diligence. Okay, I'm running along here, but typical partnership size, I'm just going to run through the key points here, because literally funds can be all sizes. I kind of said this is our key size. You know, we're 150 to 250. GP, they make the GP put some money in, because when we lose their money, they want us to lose some money. So they make it so that it's just enough painful. When my brother and I started, it was a little less, and as the business has grown, they require a little bit more because they want you to feel pain. So there's going to be a commitment. It's usually about 5%. It can get up to, it can start at 2, ours is about 10 right now. We literally, on the LP side, because we only deal with institutions, we usually set a $10 million minimum. So every institution, that's what we're targeting. I told Dr. Ling earlier, you know, somebody comes in and they want to give us a little bit less, we'll take them still, but you got to set a minimum. You know, you try to set a minimum. It's 10 years. Fund lasts 10 years. You usually have 2 one-year extensions. You have 4 years to spend it. So from the minute you do your final close, you have a 4-year period where it commit. Remember, they're committing, they're not funding. So they commit, you have 4 years to spend it, and they fund deal by deal. So we do capital draws, and then basically they want their money back in a 10-year life. Actually, most of them look for it back in about 6 to 8 years. So the 10-year life's the outside. The management fee, here's the asset management fee I was talking about. You get 1.5%. And none of this is secretive information. This is very standard for fund. So if you have a $100 million fund, you get $1.5 million in operating, and basically in management fee. And that's what keeps your lights on, keeps your doors open, runs your company. Go ahead. Sure. I think that may be true of pension, and I'm a little bit out of my skis here. I'm going to tell you when I don't know the answer. With the endowment funds in the foundations, they don't, we've never responded to something like that, and they have enough people knocking on their door, if you want to know the truth. I mean, it is a competitive thing. I mean, literally, they have 10 people a day call about providing them capital. So maybe more institutional, like pension funds, might do that. I've never seen one of those from an endowment fund or a foundation. Go ahead. We, number one, well, one, we're a niche fund, okay? We're a small fund. We don't do often, I mean, you know, I'm getting a little bit ahead here, but we have tried to focus on a very small, it's interesting, these institutions like to be in the big funds. They were getting a little bit upset with us when we got up to 450 million. They want to be in the small fund where they're one of 10 investors versus the 14.5 billion where they're one of 100 investors. They got no say. They get, you know, and so plus we have a very niche residential, certain markets. We kind of offset the Northeastern office funds. You know, a lot of them invest in these big funds in a lot of San Francisco, Chicago, New York. We don't do that. I mean, we just can't based on size. So we're sort of a little niche fund, and there's a lot of us out there. And but I mean, like, we can't go to Texas Retirement System, is a big pension fund in Texas. We've met with them 50 times trying to get an investment out of them. Their smallest investments, they don't even want to invest if you're talking less than 100 million themselves. So they're just too big for us. So you're going to get a lot of those types in the. Plus, Blackstone's bring in a bunch of foreign dollars and things that we don't do. So, sort of talk around your question there. Okay, the incentive compensation, I want to tie that back to the good terms versus bad terms deal by deal. Typical department deal, you know, if you give somebody a 9, and if I use a term you don't know, I'm assuming y'all probably are smarter than I am, but if something you don't know, please ask. But an apartment deal, let's say it's a 9% preferred return. If we develop an apartment deal, we'll get a 35, it's usually layered, but a 35 back-end participation. So in other words, when it performs at 9%, we would get 35% of the dollars above that. On a fund, it's 20%. So there's your difference in financial terms right there. And the fund's basically saying, I'm committing to you without knowing anything, I'm only giving you 20% and be happy. So there's your, but most funds, you're going to be in the, we've had a fund that's at 6%, we've had a fund that's at 9% for return. It changes over time, it's all market driven, all negotiated, but you kind of know, that's why you like a good law firm, because they've done enough, they know the range. And then basically it's a 20% return on the back. So if you think about it, somebody gives us their money, we pull it all together, we put it in all this real estate, they get all their money, capital back. I know I'm talking a little fast, but I know I'm behind also. They get their preferred return back, 9%, and then anything over that, the LPs get 80% of, the GPs get 20% of. If you think about it, that's how Cypress Real Estate makes its money. We make our money on the back end. Now, there is a little bit, sometimes a lot of discussion on the fee level and whether there's profit in that, et cetera. I won't touch that because that's a sensitive subject with folks, but what builds our company is the 20% back end. And I can tell you I've had a fund where the 20% back end was really nice. I can tell you I had a fund that we put out at the peak of the market, kind of rode through the downturn, just selling now. It's going to earn a 5% return. That means I worked on that fund 6 years and there was no back end. So that's the entrepreneurial part of the business. Other miscellaneous terms come up in the LP. Like I said, there's control. They want to control how much leverage you can put in. Usually there's a limit of 70% leverage across the firm. They want you to be diversified. We got in trouble at one, not really in trouble, but we had some discussion because we had always been 50% Florida, 50% Texas. When Florida got really expensive, we ended up investing a lot in Texas, which ended up being a good deal, but they said you too invest in Texas. So they want to look at your diversification, expenses, what controls they have. I mean, they do want certain major decisions. They also look at anything that is close to being a related party transaction or a conflict of interest. I mean, so, there's a partnership document about that thick that covers all that. I can't even get into that today. And the last point was advisory committee. There's usually an advisory committee that you have to go to if you want to do certain unique things. We can't put more than 20% of a fund in a certain deal. So, there's just parameters. We have a very broad charter, which is really nice. Our charter is, we can't do public real estate, so we can't really invest in REITs, but it's real estate in the 48 continental United States, which is really nice. We can invest across products, We can invest anywhere in the capital structure. We can do a lot. So that's a nice kind of charter that we've been able to get away with. Okay. Cypress targeted, and this has changed over time. Typical fund like us targets 25% return on a gross level. Okay, I'd tell you right now that's probably slid down to what I put on the bottom end, 18%. Things are a little tougher now, okay, in terms of making money. But that's kind of the general gross return that rate we're looking at. The fund level, the net, which means the carry's taken out, the fees are taken out, our investors are looking for a 15 to 18% return. Now remember, we're on the opportunistic value add side. There's some core funds that are looking for, 6%. So it all just depends on what type of fund you are. Like I said, we invest in Texas, Florida, and Denver. And that's always been driven sort of by, here's one of those obvious statements. We want to be in high growth markets with favorable job growth and favorable demographics. Doesn't everyone? That's how you invest. I'm going to show you one where we missed that. But we have always felt that the Texas market, the Florida market, and Denver especially fits that category. Florida's a little trickier because it's hard to track. You can get population growth, it's hard to track job growth because you get a bunch of retirees. So that makes this market, Naples, Florida is really hard to figure out. But that has always kind of been the geography. Product types, like I said, we do mixed use, residential. So we've done master plan communities, we've done a lot of multifamily development. I've even done independent senior living communities, which are an interesting industry in itself. We do mixed urban sites. We buy brownfields or urban sites. We own one right in downtown Denver near the baseball field, put together a bunch of tracts of land, accumulated them, re-entitled them, put in the infrastructure. So we do a bunch of sort of what I would call land and land development. And we have always focused on that. We have always told our investors we don't do industrial, we don't do office unless it's part of a mixed use project. So even though we can do whatever product you want, once you tell them something, you kind of got to, if you want them to re-up, you better do what you said. It's kind of the answer there. Like I said, we're on the value creation side. So all of our projects, it has some value add. We're going to buy it and rehab it. We're going to buy it and up entitle it. We won't buy something without entitlements, but we're going to up entitle it. We're going to develop, okay? So there's usually some activity that we do. We are not a sort of financial engineer or momentum investment. That's what the big guys do, and they can get away with it. They have a lot more clout than we do. We've got to look for some way to add value. We invest all through the capital structure. We'll do everything from equity to mezzanine debt, which I'm going to show you a transaction we did some mezzanine debt, to we've even done some first mortgage debt. Problem with first mortgage debt is what? Doesn't pay much in terms of return. So that has to be, the first mortgage debt we actually did on a land deal that had an option kicker to it. So that's sort of where we got our return. But and we look at where we want to be in the capital structure based on the risk. If we feel comfortable with the risk, we want to be the equity. If we don't feel comfortable with it, we want to be the mezz or we want to be the senior debt. So it really is a trade-off of you're giving up return for risk. And that kind of gets to the last point. The whole focus is kind of on risk mitigation, and it's everything from, keeping a consistent strategy to not using too much debt to watching your competitive protection. And then the last point I put there, we said structuring of the partnership investments, which are critical. You've got to figure out when things go bad, how can I step in, what control mechanisms I need, do I like this partner? Do I feel comfortable with this partner's background? How involved do I need to be? So there's how you document one transaction is very different than how you document a different transaction based on how comfortable you feel with the product, the investor. I mean, there's just a myriad of things. So we focus on that. In terms of our style, when I met with the group earlier, we were talking about, they said, do you use brokers? I like to sell using a broker, not buy using a broker, okay? We try to directly source as many investments as we can. I'm not making any comment. Brokers do a great deal or a great job. That's why I want to sell using them. Buying from them, you're buying a fully marketed, everybody's seen it. By definition, you paid the most. You're the guy that won or maybe sort of lost. I'm not sure. You paid the most. So we do a lot of direct sourcing. In our Fund 5, which was $323 million, we did not do a single deal using a brokerage. They were all directly sourced deals through relationships. I mean, looking at tax maps in Austin, you're trying to get deals that have a little dirt on them, that haven't been fully marketed, need some entitlements, have, a title issue. You're trying to buy something that gives you the advantage. That's why we are not a big fund that can go do New York, Chicago, San Francisco. We've got to stay sort of in our markets and know, what we're looking at. And, that kind of gets to this local markets to competitive transaction. Real estate is such a local business. You've got to know, you've got to have access to the real estate community. You've got to know the land. You've got to know the governmental regulations. And so that's why we've almost squeezed our markets down to very specific Florida markets and Texas markets. We are more of a local operator. That's a big pitch to our investors. A lot of us come out of development backgrounds, asset management backgrounds. We are hands-on. We know our real estate. In fact, we drive when we're a passive LP. I'm not sure our partners would say that because we are in the detail. We are in the weeds. And, we can hands-on. We know how to develop. And when I say we, I'm talking about the whole company, not me. We know the entitlement processes. We try to add value through being a hands-on operator. And, it's just a different strategy is really it. The franchise assets, we try to focus on, especially on these urban sites, on buying an asset that's a good asset in a good market and a good asset in a bad market. May not be as worth as much, but when it comes back up, it's still a good asset. So you're looking for assets that we call franchise assets that due to location, due to entitlements, have something good about them. Sometimes you have to pay a little premium for that. But in the end, we pitched our investors, we don't want to do the one-off deal here, the little deal here. We want to buy a franchise asset that we can work really hard and will be a good asset in a good market and a down market. I'm going to try and move here fast. So here's our fund history. This is just to give you an idea over the years. So we did our first private little fund, and then in '95 is when Cypress sort of came into being. And you can see we raised our first fund, and that's kind of it wasn't the smallest one, but in that range. And then you can see about every, 2 to 3 years, we raise a new fund. So if you think about it, even though we have a 4-year commitment, every 2 to 3 years, we're trying to get that money placed. And over the years, you can see they got a little bigger. Kind of in 2007, market was really hot then. It was really good. It got to the big size. We have actually made a conscious effort to bring it back down a little bit. Some of it's just due to my brothers and my age and our willingness to travel and put in that sweat equity that y'all are all looking forward to. But with funds come a lot of administrative type things, and we have kind of moved back into a development role. So we couldn't process today $450 million. At that point, we were about 10 people higher. We were only investing. We weren't developing. We kind of decided, we like to develop. And so we've kind of brought our number of investors down a little bit and and gotten a little bit more into the development side. I was asked kind of what is your fund strategy? Because whenever you go to your investors, you say, well, I got to tell them what I'm doing. We really did start with a very general fund strategy. And we ended up in the mixed use single family. We did a lot of single family lot development in the first, really through actually Fund 4, but especially in the first two, where we built lots and master plan communities. And then we kind of, the dynamics shifted of that, so we kind of shifted out of it. And we had a lot more Florida stuff at that time. Then we kind of got into a period where we started doing a lot more urban type stuff in Fund 4, 5. A lot of urban development. And we were just kind of following the market. But we've stayed true to sort of the residential, the markets we're in, mixed use, and land. So that's been our strategy. Fund 7, 80% of that's development. Where I would tell you Fund 6, maybe 10% was development. We just felt like there was an opportunity in the market. It was something we were looking at. It's a multifamily, which I'm going to get into some. So over time, it's changed. But you can see it's kind of a 2 to 3 year process. Here's the key thing about the slide. Think about, you usually have 3 funds active. So the oldest one, you're doing dispositions. The one that's in the middle, you're managing, and the newest one, you're doing acquisitions. But all in the same market. You know, it's market timing. Which, if you think about it, it makes it tricky because sometimes it's much better to be, when the market's hot, you want to be obviously selling. When the market's bad, you want to be buying. And so that's the trickiest thing about, I think, having private real estate funds. And when I talk about the current market, I'm going to show you how that's impacted us lately. Is that you've got to be doing all three of those tasks in the same time period, where the time period really impacts the success of one of them. So anyway, and that kind of ties back to there's your $1.4 billion of equity we've done. Wow, I forgot I was doing investment. Okay, so let me just run through a couple investments. And you all can read what the project is. That's not that important to me. This is a master plan community. I put this up here strictly because this is my favorite project. That's what I put it up here for. It's a master plan community in Houston, Texas. It was really the second project I ever worked on. And the key, and this actually followed why, when we started, you can see the acreage was purchased from the Resolution Trust Corporation. That entity, the bank had the land, to show you I want to give you the depth of that crash. They carried it on their books at $32,000 an acre. So they had lent $32,000 an acre on 800 acres. We bought it for $6,500. So basically 20 cents on the dollar. That's when my brother and I started. That's why we got into business, to try and do that. Okay. And basically it was horizontal land. We built 1,435 lots, built 27-hole golf course, water plant, sewer plant, roads, rec centers, whatever. And it's better to be lucky than smart. We hit Houston right at the right time. So I say 5% brains, 95% timing. This kind of started in '94, and the Houston residential market was going like this, coming out of the downturn. We had a 12-year life on it, and we sold out in 6. So, you know, I didn't do that because I was brilliant. I did that because I hit the time right. But my last point is the most important thing to me. This project shows the pure joy of real estate. I worked with the civil engineers. I worked with the landscape design. There were only 4 of us. It was me, an accounting, project manager, project superintendent. So let me go back. Landscape design, land planner, landscape design, civil engineer, the guy that did the newspaper ads, the contractors, the guy that built the architects and that build the rest. We did the financing, so I worked with the banks. Okay, I had an accounting person working for me, so I worked on the accounting. I worked on golf course design. My wife and I walked the golf course when it was still nothing but dirt. You know, we walked 18 holes one Saturday, and she was pretty miserable. But the breadth of the activities that I got to work on in this project has always kept me so interested in real estate. I mean, I worked with everybody from technical people to the marketing ad that had the big bird, the cardinal, in it, showing nature. Okay, and it just, that I think is what's important about real estate, is just the breadth of the market. Of the job. You know, there's just so much. The construction, the contractors, the home builders. I had to negotiate contracts with home builders. I don't know if any of you ever worked for a home builder, but that's a tough job, negotiating with home builders. So I put this up here just because I love the project, and I wanted to just kind of describe the breadth of what you can work on when you're in the real estate business. Okay? So no other important points on that one. This was actually a project that got us going. It's in Florida. That's why I put it on here. It's a project called Abacoa, which is in Jupiter, Florida. It was a tract owned by 2,000 acres owned by the MacArthur Foundation. And they owned a bunch of land down there. Foundations cannot develop, so they need a developer. Cypress happened to show up at the right time, and we developed it. We basically put in all of we were the master developer, put in all the infrastructure. And we built the baseball field. But it was all vertical, built the baseball field. And but it has everything from spring training facility to golf course to, I mean, it's commercial, apartments, single family. And but I mean, this was the perfect example of kind of stepping in at the right time. Okay. One thing I would tell you on this, I put in here that it's a TND deal, which a lot of people love. We were so on it, and I explained to the group. We basically were really nervous about the risk in this whole TND concept, so we pre-sold all the residential land. Okay, we got it all developed. We pre-sold all the residential land. It was under an option takedown. Really, penalties to not buy. I can tell you, I sold the last acre of land for I think it was $130,000 or $40,000. That guy, now this was 6 or 8 years later, turned around and flipped it for $300,000. So to mitigate that risk, and it was a very profitable deal. Think about what we gave away. But sometimes, you got to kind of make that decision. I don't know if I'm up for this risk. So, it was definitely something, but it was highly leveraged, and that we had district bonds on it and everything. But I think sort of the key comments here is, we had a skill they needed as a developer. We looked at the risk of it. We kind of structured the deal, and it was really an exciting, it's kind of our signature project, to be honest. Lakeshore District. I'm sorry. Yeah. Yes, the ballpark's sort of out of the picture right there. It's a training. Yeah, it's the Roger Dean Stadium. Cardinals and the Marlins right now. Now, we were negotiating with the Braves at the time, and the Braves kind of dropped us in the grease and went to Disney World. But the Cardinals and and they're still there. But you can see that sort of the, I haven't even hit on the pictures, but sort of the style is the TND style, and you had a town center. To be honest, the retail was not very successful. And the good thing is we didn't do any vertical development here. It was all infrastructure. The housing, multifamily, the commercial has all been very successful. The retail has struggled. And of course, that's the old tension in a TND deal. They want the retail first, and there's no homes. So the retail struggled for a lot of years. So, Lakeshore. This was a tract of land in Austin. It's right outside downtown, right on the river. This is where you're kind of watching the market. We had bought a lot of land in downtown Austin. We found it getting too expensive. We were nervous about it. So we said, we want a good tract of land that's just off of downtown. We literally went to the tax maps. Okay? This was not, we sent some broker out or made a bunch of strategic decisions. We literally went to the tax maps and said, where around the city of Austin, this is a down and dirty part of real estate, where around the city of Austin can we accumulate some land? It was 8 tracts of land, so we had to go to 8 different sellers, get them all tied up, okay, put them all together, and so this is sort of an example. The reason I put this on here, I'm sorry, 6 separate tracts, is number 1, it's a franchise asset, and number 2, it shows sort of the direct sourcing concept of starting with a tax map. I don't know if you all have worked with tax maps, but they're painful. And saying, where can we find the right number of tracts? And basically what we did was found a bunch of low-density multifamily where you could buy the land, buy the multifamily at land value, clear off the multifamily and redevelop it. So what we've done is all the horizontal infrastructure, and you can see the entry, and then the middle picture is the first vertical project we've put on it. But, I mean, that is a project that, I'll be honest, one of the younger guys in the office really dug deep to find it, and it's been a really good project. Austin's been a great market, and in fact, that Lakeshore Pearl has just sold and did really nicely. So I bring this up more for just the local knowledge, direct sourcing concept, okay? City center and town country. Well, I need to speed up, sorry. It was a mezz deal. The key thing about this is we didn't do anything on it other than lend them money. They needed to close in less than a month. They needed money. They wanted us to put equity in. We looked at it and said, that equity, you're buying it for too much. We don't feel comfortable putting equity in. So they $25 million senior loan. We put in 8 of mezz, and they put in 4 behind us. So we could go down $4 million without us losing any money. And they needed the money quick. So basically it was a mezz deal with a 17.5% rate, okay? Just a little under that usury rate. And the key issue here, I want to tell you about real estate, was that we put in so we were uncomfortable equity position. We put in a cost-based option. This was 35 acres. We told them, we'll take 7 acres, and I think the land price was like $25, $27 a foot. You give us a 2-year option at $30 a foot. So we're going to earn money on our mezz. It was locked out to prepayment, so we would at least get a certain multiple. And then basically, we kind of took a flyer on upside of the price of the land, right? So we said, okay, you're going to be in land at 27. We'll take an option at $30 a foot on 7 acres. We ended up selling it 5 years later for 52 acres, or for $52 a foot. So basically, we turned mezz debt, because it's tough for us to do mezz debt. It's kind of a lower return thing. But we took mezz debt and we added a kicker to it. based on the success of the project. And all we did was a land loan. It was strictly a land loan. They needed to be able to close on it. They did a bunch of work on it, and then they brought in capital to take us out and do the vertical. But that just shows you kind of a risk mitigation technique with a kicker in an effort to try and structure the deal in a little more favorable format. Okay, Indian Shadow. Remember, what was that comment I made about always, the obvious sounds easy, but it's hard to do consistently? Can somebody read to me what the IRR and multiple on this deal was? Okay, let's go down to the key points. Total lack of discipline, okay? Hot market. We don't do second home projects. We never have done second home projects. It was a hot market, and it seemed like a really good thing to do at the time. We were all excited about it. I mean, I can remember an investment committee meeting. It was going to be a winner. So, hot market, new partner, never done a deal with that partner, new product, new market, Durango, Colorado, okay? And what was the last one? So, that all shows a lack of discipline, and then you can read the last point, which results in a loss of capital, okay? So I put this deal in strictly because I want you to realize anybody that tells you about deals that only make money, they've usually omitted the losers. And there is a true lesson in in our office out of this deal. And I can tell you that it is brought up quite regularly in investment committee. That's when you lose money, is when you lose discipline, which is true of probably most things in life when you think about it. But I wanted to put in a deal that you could see that, kind of when you get out over your skis and you really don't know what you're doing, it can be really painful. So, if we got a 0.5 multiple, that means that deal lost, about $18 million. That hurts, okay? That takes a lot of the wins away in a commingled fund. So think about it, on other deals I made that $18 million. Instead of us getting a share of that goes to cover this loss, okay? Yeah, it's gorgeous. Yeah, I mean, that's the thing. Look at it. It is gorgeous. I've heard the fly fishing is really good on that. Okay, let me just, I need to wrap up here. And the current market stuff is the hardest thing to say. We have seen, and this really is very local, the acquisition market has been really, really rough for us, okay? And I think it's rough for everybody. Everything's fully priced. We basically, Fund 8 was final closings in December of, not this year, the prior year. So we're 15 months in, we have not done a single acquisition. That's rough in our office. We should do probably 4 to 5 acquisitions a year. Everything is fully priced. It's just hard to find deals. So you shift away and this makes it tougher. You got to get into that needle in the haystack approach. Really local knowledge obviously takes more time, tougher to do. So the acquisition market for us has been tough over the last year to 18 months. Disposition market has been all out of the charts. We're in the multifamily business. We sold 23 multifamily complexes in 18 months. We typically would have sold 5 or 6 in that time frame. Market's as hot as it could be. Cap rates are as low as they've ever been. And we had 15,000 units in Houston. We now own 300. I mean, we just have been selling. So disposition's been heavy. Capital markets, our attitude is development equity is still out there. In Texas, it's gotten a little tougher. We'll talk about the last key, obviously, is oil pricing, but it's been a little tougher just because of a lot of people jumping into the development business. So equity's there. It's just, that's not as big an issue to us. It's because we provide a lot of our own equity. So we don't have to, we do a few projects with third-party equity, so it's a little trickier for us to get right now, but not that bad. And debt financing seems to be fine. We can pretty much get all the construction financing we want. I'm going to skip over the rest. That's really macro stuff. The only thing that's really important here is in Houston, the oil price dropping is obviously a big, big deal. That market is frozen. Equity's pulling out of deals, and everybody's just wait and see. So we're all kind of, though we feel like that's opportunity for us. We're in the Fund 8. We need to spend it. Volatility is good as long as you're on the right part of that volatility. So I'll skip through the rest of that. The next 2 slides are really fast. A lot of our time has been spent on multifamily development. These are all the projects we've done in the last 24 months. You can see some of them are done, some of them are under construction. Actually, the second one's sold now, too. I should have updated that. Some are in stabilization, some are in lease up, so they're in all different stages. That's a lot of the Fund 7 money that I told you was in development. we came out of the downturn just feeling like multifamily was something we wanted to get into, and we really cranked up the development process. I would tell you now we're looking at deals a little harder, just as you kind of wonder, you're always kind of waiting for this, and so we probably are putting a lot more energy into it. And that's just the prior list were deals we're actually developing internally. These are JV deals we're doing with other folks. And so I don't know how many were on the prior page, but you can see we've probably done 15 development projects in the last 2 years, which is a lot for our size firm. I only bring up this really from the function standpoint. Did I miss a slide? Wait a minute. I did miss a slide because I know one time. I know a lot of y'all have already been through this, but this is just when we talk to folks on campuses, things to think about. Real estate is very unstructured recruiting, which makes it really hard on folks. And all I can tell you is persistence, 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 and you will be successful. But it takes persistence because folks like us, we don't hire every year. We kind of hire on an as-needed thing, and literally I'll tell you, one month I don't need somebody, and 2 months later, I need somebody. I mean, that's how quickly it turns. And so, real estate's just a lot of entrepreneurs, and they don't do a lot of hiring. So you got to get out there and really be persistent. But, and there's my learn facts and collect opinions again. When you're interviewing with people, listen to everybody, because there's a lot of opinions out there, and that's kind of what's going to form your basis. And believe some of them, don't believe others. You need to figure out things about the industry. It's cyclical. It's very capital intensive. Long time frames. That's something I never imagined. Think about a multifamily development. Man, it's a year to buy the land, 2 years to build it, 2 years to stabilize it. It's a 5-year deal, and that's a fast project. We have some projects that are, in their 10th year. And so it is it's just a long time frames for deals. It's not something that turns around in a month. And a lot of government involvement. You need to figure out your geography. You need to figure out your product. And then the last point was functions. That's how I knew. And figure out kind of what you want to do. And I give you this not because Cypress's organization is important, really more just to see what an organization like us has. We've got about 25 people. We are very entrepreneurial. We don't have a lot of hierarchy. We have an investment committee meeting, an asset management meeting, and that's about it. My brother and I are not really good at administration. But we have an acquisitions folks, okay? That's usually, you've got to be in the business a while because you've got to have a Rolodex. You've got to know how to source deals. So that's development. We've got 5 development people doing multifamily. That's a little tougher to get directly into. It's also the most cyclical of all the functions, I would say. Development guys printing money when times are good, and they're out of a job when times aren't. So, that's a little trickier. We have capital markets, which is basically raising our equity from our investors and raising debt, bank debt. We do a lot of bank debt, and that takes a lot of time for construction debt and everything. Asset management, manage our assets. A lot of the asset management people end up in acquisitions because they've kind of learned how to structure deals, and they've managed projects and seen how they go. And then we call financial analysis and valuation. Financial analysis is usually a junior person under asset management, and valuation is because we're our fund, we have to get a full-blown audit every year, and we have to market value our assets, really quarterly, but an audited market value. And so we spend a lot of time valuing our assets every year. And then accounting and administration, which in a fund format, you have more people because there's a lot more reporting. We have a lot of tax issues for our investors and REIT issues and market, so it's we don't do asset management or property management or leasing. It's just been a decision we've made over the years. I wouldn't say that's a plus, minus, or anything. A lot of firms have them, some firms don't. It's just kind of an individual. All our assets, multifamily deals, all have a third-party manager. But that was just, I don't know. We just ended up there. So, okay, I'm going to make 2 or 3 points on this slide. Don't be afraid to get, and really, I actually have very strong opinions on this slide. Don't be afraid to get hands-on experience. I mean, I was telling Dr. Archer at lunch, I leased my first few years with my brother, and to this day, I still know the important paragraphs in a lease. Okay, and I negotiated those leases with tenants, and I did the property management on a warehouse buildings, and it was down and dirty business. But I tell you what, it is the best knowledge that I have, and it makes you understand the important things to think about. And so, I just think sometimes people in overlook, they want to kind of jump that stage. And I really do think those first few years, you've got to build up that knowledge. We're really big in our office on the financial analyst side. We feel like if you're a developer, asset manager, acquisition guys, you've got to understand the numbers. I don't want a broker that doesn't understand the numbers, okay? And maybe because I come from an accounting background, that kind of adds to it, but everybody in our office has got to know how to run numbers on deals. If you don't know how to run numbers on deals, you will not survive in our office. So while going and grinding out numbers sounds a little dull, do a couple years of it, I promise you'll understand how real estate works. Detailed knowledge. There's all these rules of thumb and things that with experience and focus and, I use another example at lunch. Don't come to the asset management meeting and say, I'm managing this apartment complex, and then somebody says, how many units does that apartment complex have? And give a blank stare. I mean, it's your asset. You own it, okay? You've got to know, what the rental rates are, how many units there are. I mean, there's just, and if you're in the development side, my development guys who really are the developers, not the construction guys, I bet you they can tell you what the doorknobs cost. I mean, it's just a level of detail that you've got to know because the detail people. Let me keep going here. I already said be an owner, think of it as your personal capital. That's the first thing I always tell my young people. If you don't look at it as your asset, you're going to miss what you should be doing. I guess I said focus listening just because real estate, there's so much negotiation. There's so much presentation of facts. And so when you're in meetings as a junior person, even if you're not, obviously leading the discussion, watch the dynamics, watch the looks, watch the tone, watch the way a very sensitive issue is brought up. May not be a punch right in the face, it's around the edges. And so I guess what I'm just saying is don't zone out. Real estate is so much relationship oriented and negotiation. Every deal starts with a negotiation. And so you really have to kind of watch that technique. And I think when you watch good people do it, you almost subconsciously pick it up. And I'm just going to finish with passion for real estate. Man, you got to like it. You got to like it. I really do believe when my brother and I started and we were doing Longwood, we couldn't wait till Saturday morning. During the week we were too busy till Saturday morning to get out there on the site and walk it and see what was going on and walk the parts of the land that hadn't been developed. So you got to kind of, if you want to be good at it for a long time, and I really will actually give my brother a lot more credit for this. That guy loves real estate, and he always has. And I mean, it is just, he has got a passion for it that's never ending. And I think, that's what, kind of makes it fun for 30 years instead of 5. Folks, that's it. I'm sorry I ran a little long. Any questions? Any questions, comments? I promise you, I'll make the question sound smart. Nothing? Go ahead. Right. Yeah, I mean, it's, let me start with a story there. At one of our annual meetings, I think it was in Chicago, we made the comment, at one point in the discussion, the comment was made that we are fine. We've got the liquidity to make it through. None of our bank loans are coming due. The focus of the investors change in the downturns. They want to make sure that you can pay all your loans, that you're not going to run out of funds. And it was such an amazing thing because at that point, one of the investors said, okay, we're done. I'm going to go to California. I got more problems out there with some of my things out there. So, I mean, the key to the real estate business obviously is making it through the downturns. I mean, the good times, we always say the good times hide all your mistakes. Everybody makes money, you make a little mistake, it gets hidden because everything's riding up. During the downturns. And it really comes down to liquidity because I always look at it, and being conservative. We always are staffed, one person less than we need. which makes it tough on those of us that are there sometimes. So you kind of run your organization a little leaner on just the organizational side. But then even on the asset side, you know, it's a matter of liquidity, because I always make the comment, if you buy a really good asset before the downturn, it's still a good asset afterwards. But if you run out of money halfway through, you give it back to the bank. Okay, so it's really a focus on liquidity. When, I think let me pick the right year, whether it was December of 2007, we started getting nervous, so we went and restructured a bunch of our bank loans with an extension. Every one of those extensions cost us a prepayment. So, you know, you got a $20 million loan, and they say, yeah, we'll extend it, but you're going to have to pay it down by $5 million. And so what we did in our Fund 6 was we took a lot of our liquidity, we hadn't spent the whole fund, paid down those loans to extend them out beyond what we thought, you know, the market would come back up. So, you know, a lot of it's just, I think, being conservative. You know, we do take a little bit of an attitude. You know, there was some, I'll be honest, there was some risk in our Fund 6. If we had been 95% spent, it would have been a tough downturn. You know, we had only spent about 60%, so we had capital to pay those loans off. So some of it was luck of timing. I mean, just like anything else in life is. But I mean, it really is kind of managing your liquidity, buying assets that, you know, that aren't going to drain your cash, that if you need to sit, you can sit, you know, that aren't going to be a constant cash feed. So it's, you know, I think it's just a multitude of things. But I can tell you that our fund, you know, the investors look at funds as just like wine, vintage. What year did you do that fund? And they benchmark you against the vintage of your fund. Because I can tell you when Fund 7, it was hard to raise, 2010, we could hardly, I'm getting way off topic here, but this is my stream of consciousness talking. We could hardly get some of our investors to just put money in, because they was like, we can't go to our investment board and put any money in real estate. 2010, everything's tanked. It's our best fund. Those that put money in Fund 7 are literally, I mean, it's going to be a double. So, you know, it's kind of the different time. So anyway, getting back to the whole vintage thing, there's the vintage of our fund, I'm trying to think if it was 6 or 5, 6. This rule of thumb is that funds with that vintage are returning 80% of the capital. So they're comparing you against a benchmark of getting 80% of their money back. We're getting all our capital back plus about 3 or 4%. So we're okay. But still, it is, you know, you are watching vintage and your benchmarks and everything, but the worst thing you can do is have to go back to your investors and say, I need more money. I mean, that's like, you know, the whole thing of how do you raise your funds? You raise it on your history. The first one's tough, but you're raising it on your track record and your history. When you say, I need more, you know, the fund's $100 million and I need everybody to chip in, your history's gone. You will not raise another fund. And so, you know, that's why a lot of times they give it back to banks and everything. I mean, you just can't go back for more money. So it's just, you got to be, you know, our investment strategy a little bit, and I think helps with this, is I would rather invest in a deal that's got a spectrum in our mind, or I don't know, this needs an academic term. What would you call it? Sort of range of possible outcomes, 0 to 20 versus negative 20 to 50. We just, you know, negatives just are not acceptable. So, but when you make that decision, you squeeze the upside down. I mean, you're not going to get that every once in a while at 75 if you're not willing to take it, you know. And so some of it's just a kind of conservative nature, and we've always felt like we're a small niche fund. We got to rely on our history. We're not Blackstone, and we want to be able to go back and show them. So, I mean, I think it's just a sort of your attitude and how you work your way through it. But liquidity is definitely king in real estate. You know, it's not how great an asset is, because you can have a great asset and have to give it back to the bank. So, does that answer it? Sort of? That it? Oh, go ahead. Okay, the tax maps, you know, all counties basically charge property taxes. And so you can get on the website for, I'm sure you can do it, in fact, I'm sure you can do it in Florida because I've done it, that basically, it's Travis County Appraisal District, and they appraise all real estate property, charge property taxes. And basically by doing that, you can get on their website and look at their tax maps and see the different parcels of land, and you actually can get an owner name And they'll have an appraised value, but the tax appraised value has no relationship, excuse me, it's supposed to have a relationship to market, but it doesn't. But basically it lets you see sort of where the land was. So basically we said, well, we want to be close to downtown. This area over here looks like it might be possibly good for redevelopment. It's right on the lake, across the street from the lake. And you basically get on there and you say, oh, there's an apartment complex and that's this land and this piece, and you kind of piece them together, and then you basically get on the phone, start calling it, trying to track down those owners and seeing whether they'll sell. And so it's just sort of a real down and dirty way to try and find real estate. I mean, it's not a broker coming to you and saying, hey, this apartment complex wants to sell, or this owner wants to sell, and here's a pretty marketing package, and it's going to sell for X. I mean, it's getting out there and trying to almost talk somebody into selling. We did 6 on Lakeshore. Denargo, which is our deal in Durango, in Denver, I think there were 13 parcels, but some of it was owned by the same. It was like 8 or 9 owners. So I mean, it's just a direct sourcing, trying to find value. That's sort of the old needle in the haystack approach. Everything's not going up. You got to go find deals. Yes. You're trying not to. I mean, that's the whole thing, is you're trying not to. Obviously, once one guy knows that the other guy is on the market, his price goes up. So you are definitely trying to work it as hard as you can. In fact, we work it as hard as we can to the point of having different people in the office approach different sellers under different, we have all these legal entities that you own property and you own them all in different legal entities. So we have a bunch of legal entity names. And so you're literally having different people approach them with saying such and such wants to buy it and trying to keep it down, because once it heats up, it can, you're going to pay more. Is that it? Well, hey, I really appreciate y'all showing up. I enjoyed it.